Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to look at how to model option strategies in the context of a corporate decision support tool for risk management. And that this involves a set of integrated financial statements capable of handling fair value accounting, which is how these options are supposed to be treated in the financial statements. So, for more on derivative strategies, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Alviniusen and Uxelheim. There's more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. All right, so derivatives are highly flexible tools for managing a risk-return profile. You have all these basic building bricks, right, that you can put together in various ways to create the kind of risk-return profile that you find desirable. And the message in the academic literature on this subject is that you can use these to help secure various objectives, like investing according to plan and meeting your debt liabilities in a timely fashion and staying out of trouble, right? And that's how you create value using derivatives. And options are, widely used variety of these derivative strategies. And you can make a case for them by arguing that, well, whenever corporate exposures are nonlinear, the optimal strategy will be a nonlinear one based on options. So, and we have identified various settings in which corporate exposure can be argued to be nonlinear, but that's covered in another tutorial. So, and when the optimal hedge ratio, on a basic level, how to think about it is that when the hedge ratio, the optimal hedge ratio, depends on the state of nature that you're in. So that maybe you only need liquidity if the price goes low enough or goes high enough, depending on what your exposure is like. But maybe not, you don't need to hedge so much in outcomes outside of that range, so that you very specifically want to hedge a part of the outcome distribution that you consider dangerous, and that's what you want to zero in on, and options will help you do that, so that they generate this conditional liquidity and equity exactly when you need it. So we can think about options that way. And as we've discussed in earlier videos, we want to be able to proactively evaluate hedging strategies in a corporate decision support tool, because we know that there are multiple consequences on corporate performance from these derivatives because of the need to fair value count them. And if we want to understand how they can be used to support the value creation process in the sense of financing the investment program then, or meeting various debt liabilities, well, that is best done within the context of forecasted financials. Right? So we want to set up a model for that. With complete set of integrated financial statements, you have all this accounting and analytical integrity to make it a reliable companion for decisions in risk and financial policies more generally. So this is called risk budgeting, when we express the risk of the firm as a whole using these financial numbers, the cash flows, balance sheets, and net income statements. And we want to see now how option-based hedging strategies fit into that, how we can incorporate these into this framework. So we're going to take a model that consists of 1 year forecast horizon, and there's 4 quarters in that year, so it's a quarterly time resolution. And we're going to have a look at a put option strategy for hedging some revenue risk. So we're essentially a commodity producer, you could say, and we set up our chart of accounts in the model so that we have the lines necessary to make it self-balanced even after considering derivatives, right? So you have the gains and losses over here, realized and non-realized, and you have assets and liabilities. So when you set the model up, those lines are appearing here, right? Gains and losses in the net income statement, and you have some liabilities and assets in the balance sheet, and hopefully we can make this come together and be IFRS consistent so that the whole thing always balances. All right, so let's have some revenue and revenue risk in place. Here's one of these schedulers where you just take a certain production volume that you've indicated, and you decide which quarter in which that is going to be realized. In this case, we have asked the model to put it in the fourth quarter. So it does. And we do some, we implement a setup here so that we can choose between different scenarios. We're going to have a down scenario where the oil price goes down, expected scenario when it's sort of, this is what we believe is going to happen, and the up scenario where it goes up. So we choose it from over here in this drop-down menu, and the model will pick the scenario that we have indicated and send that into the rest of the model. Right? So you have a selected scenario over here where there's user control. So if the oil price scenario is the expected, it will pick C5, which is over here, right? So, and then you drag the formula out. And there's this is a nested if statement, so that if this is not true, then there's another if. So if the oil price scenario that you've indicated is down, it will fetch this value. And if that too is false, then it will take the remaining option here, which is the up scenario. All right, so we have now the expected scenario in place. We have chosen that. So that 200 in production volume now will become a cash flow, a revenue at that point. So that simply multiplied by the relevant price over here with the volume, you get this revenue. And then we are also going to implement a put option strategy. So we have a hedge volume for that. We have to select the strike price because an option requires you to do that, right? That's the core feature of an option contract, right? You get to decide what your strike price is going to be, at which point your protection kicks in. From that point on, you have some coverage. So we set the model up again. If statements, it's an if and one of these composite ifs, and it checks whether the quarter and year are the ones that you have indicated over here, right? Due quarter, due year. But then, in contrast to the forward modeling we did in another video, here's there's going to be a max function involved. So because of this attractive feature of an oil derivative, an option contract, right? Where you just walk away if it's an unfavorable outcome. That renders a zero as payoff for you. That's the privilege you get as a holder of an option, right? Whereas if the strike price in this case is higher than the spot price, this means whenever the spot price takes a dive and goes down, you are in for a positive payoff here, possibly if it reaches that level, and you multiply that with the hedge volume, right? So we now, and in this case, because of the scenario being the expected one, and which is relatively good, we don't see when we implement this formula, we don't see a payoff because we're always going to be on this side of the zero. So, but then we have this feature or this fact that derivatives are supposed to be fair value accounted, right? And that goes for options as well. So we have to find a way to have the model, reflect estimated fair values at future points in time because we're forecasting these financials. So we have to make it so that at these quarter ends, in the forecasting horizon, there's going to take place a valuation. It's as if we were there at some point in the future doing a valuation. We have to anticipate that in the model and instruct it to act as we would in that situation, so that we get a realistic description of the corporate financials across a large number of scenarios. And that takes us beyond the realized cash flow payouts, which is usually what corporates go to trouble of doing, right, when they look at derivatives. So, and this is worth a while because more and more things are being fair value accounted, and the fair values can have major impacts on the overall performance, right? So the trick is to implement this while still making the model balanced, right? So we want to be IFRS consistent also here. So as we've discussed earlier, in other videos, this is about finding the relevant valuation formula and forecast the variables that go into that formula. So we've done that for forward contracts earlier. Now the time is here to do that for option contracts, right? So in each forecasted quarter, we're going to derive a fair value given the forecasted variables in that, and just feed that into the formula and have the formula process that and deliver an estimated fair value. So we're going to use the classic Black-Scholes here. There are others out there that could suit your purposes better, but let's keep it as simple as we can here and use something that we've seen before. So if you work through this formula here, you find that there's a spot price reference. It refers to strike price. There's an implied volatility there as input. You're going to need an estimate of the risk-free interest rate, and time to maturity will matter to the valuation as well. So the fair value of any option position here will depend on these variables in such a way that, you know, it's positively related to strike price, for example. The more volatility there is, this is how we learned options back in school, right? So we're talking about just implementing that. And I will assume that you're familiar with this and seen it before, so we're not going to discuss it to any large extent here. We'll move on. So we need to generate forecasts for these things. And what if then we're willing to make some simplifications here, that some of these are constant? Let's say for now that we are going to say that implied volatility is 30% now, and we expect it to remain so at that level, right? The interest rate is 3%, and we expect no change in the interest rate. So it's going to be 3% throughout. And this is our starting level for the spot price, and this is the forward price with a maturity capital T, you know, a 1 year horizon here, so that would be 1 year. So technically, we're not referring to the spot price here. It's going to be the forward price because we're dealing with forward rates. When the underlying is stock price, you might, well, then it's a simple matter of feeding the stock price in there. But here will technically be about the forward price, which is then, of course, a function of the spot price. So since we have all of that now, we're if you want to understand how we derive the future forward price here, you can check out the video on modeling fair values of forward contracts. But it is perfectly possible to drive a forecasted value for the forward price and use that as input into the formula. And all these others are then available to us because the strike price is a given, time to maturity is deterministic. The spot price is sort of assumed, that's an assumption in the model, and we'll vary then this later as we investigate other scenarios. But these are all available now. All the model variables are forecasted. So we just have to send them through the formula. So we do that here in a series of steps. This is just executing the formula as it appears to you in your textbook, right? We just do it. And then we get, at the end of this, the value of one call option contract and the value of one put option contract. So now it becomes a matter, okay, how much are we going to hedge now? What's the number of contracts involved? And apply that number to this. Scale it up by the hedge volume here. So, and this is what we do here. We have the same, just repeating the steps here, and we arrive here at the values, right? So the fair value of this position will be exactly B12 then, the put option, because that's the kind of strategy we're evaluating here. And we've hedged a certain number of contracts. So that gives us this number. We're now talking fair values. These are estimated fair values. We just repeat that in all the quarters in our forecast, right? So these are now valuations that we assume are going to take place at that point in time. And when that person does that valuation, they're going to refer to all these, numbers because that's what, the scenario we're in. So we're able now to anticipate and forecast financial sort of fair values perfectly well. So we have sort of enhanced our model and upgraded it to cope with fair values. And also, we can distinguish between intrinsic value and time value here. Intrinsic value being whenever the payoff is in the money, like we're already have reached the threshold, the strike price. So it would pay off if we were to exercise it already today. it's not doing that in the expected scenario. So it's 0, and everything will be time value. There's an option is always, or you know, you can have a positive value even when you're out of the money. So that, because there's always the chance that the price will move in such a way so as to get you in the money, and then it will have a positive payoff. So the mere possibility of that payoff is valuable, whereas the downside to you is capped by the fact that you will walk away if it's unfavorable at the end of the at the end of this cash settlement, right? So all right, so we can realistically then keep track of time value and intrinsic value in all these scenarios. And time value is, of course, the difference here between the fair value and the intrinsic value. And it's interesting then to note that the fair value at inception is also the cash premium you're going to pay. I mean, that's today, given the market values that you do see for all of these inputs today, right? So that would be what you end up paying for if you want to go ahead and execute the put option strategy. So it will take cash. You will reduce whatever cash balance we have, and that's how it works, right? For this privilege of being protected, but having the upside preserved, you have to pay for that privilege. Nobody would be willing to provide that contract otherwise, right? So the initial fair value is also the premium. So we're going to have to pay that. So there's a cash outflow, but what's important to see here is that it's not a cost in that sense of the word. You're actually investing in a derivative asset. So we're going to write up that account in our, we have the chart of accounts, including derivative assets now. So cash assets go down, but derivative assets go up by exactly the same number. So it's not a loss. Equity will be unchanged. And this is important to see that in the traditional sense of the word, put option is not a cost or any option that you pay for, because you get an asset that has the same economic value. They should correspond, hopefully. If there may be cases where they are not the same because you're being taken in, but that's a different matter. Let's assume now it's fairly priced, and then your asset is going to be worth as much as the cash you're paying. So investment in derivative assets, that's how to look at it. And you see that here, that initially you have that. You credit the derivative assets in the balance sheet, and the cash assets are reduced, so that there's zero effect on equity here at the inception, right? But then as we move out in time here, and we are looking at this scenario, and we'll get a new estimated fair value in the next quarter, right? And then as we repeat this exercise, but there's going to be a difference here, the change between the two quarters, and as per the accounting rules, that's a gain or loss to be reported net income. So that's the principle of it, right? Any change. So it's like we're investing in a derivative assets, but then it's sort of gradually depreciating over time because it stays out of the money, and so the closer we get to maturity, it's sort of losing more and more of its value. There's still some time value left, but less and less of it, right? So it's as if you were depreciating. It's a depreciating assets in that sense. So, all right. And here, yes, we're happy. We're going to make it balanced. That's the purpose here. So we have the revenue risk here that we're trying to hedge. There is no payoff ultimately. It ended up not in the money, so there's zero payoff, right? But you have these accumulated unrealized losses here because you depreciate the assets and ultimately it's going to be worth nothing. It expires out of the money. But it's an unacceptable outcome because in the expected scenario, the price is decent, right? So we get a pretty good revenue. So everything is fine. And here we have derivative assets booked on this account. We paid for the premium initially, so cash is negative. I mean, this is not realistic, but it's just to isolate the principles that are at work here. And retained earnings is also negative because cash is, right? So you're making these losses, sorry, it's because you're making losses. the unrealized losses over here. That's what is creating a negative equity here. But then the revenue occurs later, so you end up with some positive equity. And all of this is balancing because the equity effect is ultimately what corresponds to the difference between assets and liabilities. So we're fine. But let's take a down scenario now. We go back to the settings and we choose that instead, so that the model now activates a bad scenario, where it goes down commercially. We're losing money now, much worse than we expected. So maybe now the hedge has a role for us, and we see here also that it does go below the strike in Q3 here, and ends up actually well below the strike. So let's see what happens. So we now, in this scenario, this is one out of a great number we can evaluate, right? And we rerun the numbers through this formula, come up with new fair values each quarter. I mean, since we're in a different state of nature now, that everything has played out differently, the fair values will be different. And in this case, there's also an intrinsic value because we're in the money here. We have the strike being larger than the actual spot in this scenario. So that is to our credit now, or we gain from that. We get the protection that we have paid for. And we multiply that by the hedge volume, right? And then time value is still the difference because there's obviously a chance that it could get even worse, right? So there's more value right at this point to this contract. And it's also interesting because, again, one of the points of modeling it like this is that you learn so much, and the model will surprise you because you didn't see it coming, or your intuition was suggesting something else. But look here, when there is a down scenario, so you would expect the fair value to come down. But if you go back and look, it's only a small decrease in the price in between these two quarters. So that is driving the price up, right? Or the fair value up. But at the same time, there's less time to maturity. So we're losing time value. And that effect is the larger in this case. So it ends up being a decrease here. But then as there's a larger sort of drop in the price in later on, that is the larger effect, and we see a positive value of the contract. And here it matures, so there can't be a value when it expires, right? That's when it's replaced by a cash effect. So again, we're going to implement this, and we have the revenue being lower now, but in this case, there's a realized positive effect. And you then have these unrealized effects in between, right? And then reversing the previous sort of, or whatever unrealized gain or loss you had up to that point is reversed, and you have just a cash effective one. Right, so you end up positive cash effect. Right, so that is then becomes a cash effective here, helping you to improve your sort of financial performance in that quarter relative being unhedged. It's not quite offsetting the entire drop in the revenue risk. If you go back and compare, it was 9,000 before. So the drop in revenue is larger than the payoff from the put option. But that is because you just established a floor. You didn't have protection in between what you initially forecasted and your strike price. In between there, you're exposed. So you have to take that loss, right? So that is why you don't come out with the same number as in the expected scenario, but some protection is in place. So, and it still balances, so that is the great thing. So the conclusion here would be that, yeah, we should definitely model these option strategies in this way, where we compute the fair values in each of the quarters in our forecast, because we know the formula. It's just a tiny bit more complicated than a fair value formula for a forward. But it's right there. You just take some implementation, and it's going to do all of that then. And you now have sort of predicted integrated financial statements that are perfectly consistent with IFRS and all these principles. Right? So, and we also take away from this that we need to remember that the cash premium pay is not a cost. We're going to credit the derivative assets account here, and you basically invest in derivative assets. So those balance out. And we do pick up a lot of insights here by implementing a set of integrated financial statements and running the option strategy through that. It keeps track of lots of things that we easily would miss otherwise, and it's a great comfort to know that the model will, in any scenario, just calculate the correct numbers and send that into the financial statements, and you can have a better understanding of what the company would look like in that scenario, and do many of them. All right, so that was it for this time. Please read more in my books about derivatives, and there's also more information on riskbudgeting.se. And as I say on YouTube, please like and subscribe. Thank you and have a good day.